Welcome to Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. It's my pleasure to welcome the CEO of Value Research, Dhirendra Kumar. Dhirendra, welcome.
Thank you, Rajesh.
You know, when we invest in a mutual fund and when they become very big, the question that comes to one's mind is, are they good investment as well?
The answer is yes and no.
Okay, let's go to the yes part first.
Yeah, the yes part is that in many cases, mutual fund is a business of scale, and it has increasingly become beneficial for investors that bigger the better. In many cases, there are some exceptions to it. Many small funds, many strategies are good only for being small. If they turn big, those strategies fail. When it comes to large cap funds or the ETFs or the the debt funds, the liquid funds, bigger the better. You are able to de-risk yourself. You are able to, now SEBI has also provided that if a fund gets bigger, it is supposed to, it has to charge lower expense. So it is, you get the economies of scale. So in many cases, the large cap funds, the ETFs, the liquid funds, the ultra short term bond funds, bigger the better.
Bigger the better. Okay, what about the ideal size? The biggest one that I believe that's going on is 22,000 crore range, between 22 to 24,000 crore range. So does it matter, the size, the amount that is there?
It matters in some cases. When it comes to actively managed fund, getting very big means that the fund gets difficult for it to maneuver. But think of an index fund, an ETF, where it has to do nothing. It is in the business of replicating the index. The index the popular index in India that we have are the ones which are investing in only large companies. Large companies, you have enough liquidity. In India, and one fund has actually become a 51,000 crore fund, right. the Nifty ETF. But I don't think it is going to be a problem because, it can well be run, because when you look at the underlying component, a fund is nothing but where it is supposed to be investing. And where it is supposed to invest, if they are not liquid enough, you are in trouble. You will end up buying something which will not be liquid, but you are supposed to be buying that necessarily. And when you want to sell, you will get stuck. That is not the case with the Nifty 50. There is no liquidity issue. But yes, it still has to be tested. Okay. Equity market in general, if you have very substantial sale, it has an impact. There is an impact cost. Prices do go down if a lot of people turn up to sell their investment, and that is the case with, at a certain level, demand, supply, or on a day-to-day basis has an impact. But I don't think, there is any problem of scale with the liquid fund. We have seen, 80,000 crore large, big liquid funds, and it was better, it was good, it was safer, it also had the economies, and it was also being run with great intensity, simply because the AMC had great skin in the business. It was so substantial that if it does poorly, it will have an impact on the business, howsoever low the expense be. So I would say that we still, most of our equity funds, even the actively managed funds, are far from achieving a scale where it becomes a deterrent to their performance. Index funds and those mechanical funds, I don't think there is any liquidity issue. What has happened recently, that is effective 1st of April, that they will start, some of these big funds, they will start getting the advantage of scale and passing it on to investors, because SEBI has clearly made a very differentiated expense advantage for the larger fund. In all other business, when you get big, you get the pricing power. Mutual fund has become a little different. When you get big, you are supposed to charge less. Yeah. Of course, on an aggregate, mutual fund companies will be making more money with their big funds. But the formula has been that up to 5,000 crore, X%, X minus some percent for the subsequent. So when you get very big, investors benefit. And that should translate into something very meaningful over a long period of time.
Okay. Vis-a-vis the free float market size of the Sensex, which is roughly about 39 lakh crore rupees, the large fund size, as you said, the biggest one going is 51,000. So the advantage in this scenario is that you get lower cost and liquidity.
Yeah, Indian mutual funds are very tiny right now. If you look at on an aggregate basis, stock ownership in India is nearly 51% promoters. The owners still own a good part of it. Then the FIIs, domestic institutions, mutual funds, they just account for about 8%. So they are far long way off. And then the market dynamics is changing. We still have a lot of businesses which are not in the public domain, a lot of businesses which are still not held by institutional investors, which is indirectly held by individuals. Mutual fund is one such vehicle, or insurance companies buying stocks. So we are far from there. I don't think mutual funds have hit a problem of scale yet.
Okay. So you've mentioned about the positive side.
Yeah.
What about the flip side of it?
There are strategies where getting big is your disadvantage. What in mutual fund context will be called as winner's curse.
Okay.
If a fund is supposed to be investing in small cap, small companies, mid-sized companies, or following a strategy which necessarily requires spotting some opportunity and waiting for it, and they turn blockbuster. Uh, because all that we are talking about active management is beating the index, but somebody is working on absolute return strategy, then you have a problem. Running an open-end fund, what is called winner's curse. You do very well. And the moment you do very well, a lot of investors put money. And you were doing well because you were able to implement a strategy because you are small. You could do it on 100 crore, you could do it on a 300 crore corpus. When you turn 5,000 crore, that itself becomes your disadvantage. You can't maneuver now. You can't really, and even if you succeed, assuming that somebody was investing in smaller companies, and he was investing in smaller companies to the tune of 25 crore each position, and having 20 such position or 25 such position, and he succeeds with 10 of them. So this is a 500-600 crore fund. And because you have given superlative returns, extraordinary return, a lot of investors put money, and now you suddenly become 5,000 crore fund. Now you have to look for so many other opportunity. The underlying liquidity may not be there. So many strategies may not be replicable on a larger base. These strategies are, some of the thematic funds which funds launch, or the small caps and the mid caps. They will have a size barrier.
Okay.
When they turn big, worry about it.
Dhiren mentioned about the winner's curse, and what I also understand from this, Dhiren, is that funds become less agile.
Yes.
Yeah.
And for some strategies, it doesn't work. Yeah.
And also a drag on performances.
Yes, yes.
Correct? So if that is the case, what is the role of the fund manager then?
No, they have to act responsibly in a sense that
They cannot stop people from investing. So
they
the
can well
winner-
stop. There has been instances where fund
they can.
companies, they can, because, if it is going to be, it's a matter of, building reputation. It is a matter of guarding the interest of the core investors. If a fund manager, but at the same time, it is disadvantageous for a business because you're in the business of, so there is a natural conflict that you get more money, you are able to earn more money. And the moment you say that you won't take more money, so you have to succeed and do well with what you have. So this is a natural conflict, and now SEBI has increasingly made it very difficult for fund companies to launch similar fund. Okay. You can say that, okay, I'm stopping the money, I won't take money here, but I'm launching a similar fund, and people can invest there. You can't do that.
Okay. What about the debt funds?
Debt funds, generally bigger the better. Here also you have the exceptions, that there are certain strategy, credit opportunity fund, which requires hard work.
The winner's curse will not.
Winner's curse do not apply. Okay. It applies only on a very small set of category of funds, but largely it does not apply. And here, bigger the better. And bigger the better on all counts. You have the economies, the fund company is interested, the fund manager is interested, and then you are able to de-risk yourself better. Think of, a fund is very large, say a 50,000 crore or 70,000 crore fund, and it has a lot of positions in many credits. Assuming the fund faces a calamity or faces a crisis, one is that your relative position in a security will be so less that it will not have a significant impact. The other is that the economies of scale, you will be able to deploy greater resources in ensuring that you will be relevant. In fact, in debt fund, you get one more advantage which you typically don't get in equity market, because equity market is all electronic, all digital. In the debt market, it's an informal market, and somebody has to negotiate a deal for buying a security, and once you have the muscle, once you have large amount of money, you are able to get a finer pricing uh, to a great extent. So in by all counts, bigger the better. Some opportunity, the credit risk fund or some such thing, but those are the kind of fund which individual investors should keep away from anyway.
They also say that there's the ability to negotiate better terms with the issue of debt. A bit of elaboration on that?
Uh, think of a fund company which is going to buy 50 crore worth of a security, as compared to a person who calls up and says that I want 800 crore of this security yielding this much with this much maturity. Right. The guy will be working very hard to serve that 800 crore customer. Bigger the better. You are able to negotiate, and the brokerage or whatever the fulfillment cost will be far lower.
Okay, so what would be your advice to the investor about the fund size? To me, you will say get into big.
No, I would say that don't worry about it as of now. Only to the extent your small and mid cap fund, worry about the size. The rest of them, you are far off from these funds achieving a scale where you have to worry. And let's see, our markets are fast changing. A larger scale of a larger mutual fund industry can actually solve most of the problem. Greater institutionalization of the market itself will be solved. So I don't think we are far from we are reaching a stage where we should worry about size for most of the funds. Small and mid cap funds, worry about it.
Okay. So what Dhiren is saying to you is don't alter your investment decisions based on the fund size. And secondly, what he's saying is just go by the performance track record of the fund.